All right, y'all. Welcome to Talk Heavy Media Podcast with Real Credit, Miss Nina and Miss Tosh, talking all things real estate and credit. Welcome to the podcast, y'all. We're gonna dive right into it today. We're gonna dive into how credit and real estate blends together and how you can leverage both of those things to create passive income.
Yes,
Sound
sir.
good?
Absolutely.
Let's get into it.
Let's get
Let's
into it.
go.
All right, so Miss Nina over here um, is a credit repair specialist, as well as matter of fact, I'm gonna let Nina you introduce yourself when you run your own resume. I'm over here speaking for you. That's the all rule of me.
Got you. So, hey, y'all. So, I'm Nina Bourdet. I am co owner with my husband. So, I am a credit repair owner. So, I own Rising Elevation Consulting. I also do short term rentals under Rising Elevations. I'm a boutique owner as well. So yeah, we help people repair their credit. We do business and personal funding as well. We provide financial literacy as well to those that are in need. So and help you also not just repair your credit, but we also help you build your credit as well. And also, I do a little real estate as well. I own a real estate investment property as well.
And this other beautiful lady over here to my right is Miss Natasha Bass. You have the floor. Introduce yourself.
Hey, what's up, everybody? It's your girl Tash. I love just helping people, period. And so, what I've done is I've had the opportunity to start my own credit repair company called Intel Finance Solutions. In addition to that, I am a real estate agent, actually a realtor. And what we do is we help individuals buy, sell, and invest in real estate properties. Um, Lately, I've been getting heavy into the investment side of real estate. And so just found there's so many levels when it comes to real estate and utilizing your real estate as an asset as opposed to a liability. And so that's what I want to share today.
All right, so let's get in right into it then. Let's start from the aspect of what good credit can get you in the real estate market. Nina, you got the floor first.
So good credit is key, right? And also it depends on a lot of different things, right? Your income, of course, your credit plays a good part of it, and location, right? Because you have to be able to afford where your credit and income determines where you're going to buy, right? So for me, I would have to say this is actually my third time buying real estate. Bought my first house in 2007 when I was 27 years old. During that time, that's when the market had crashed. Right, I didn't know anything about real estate. I was a first time home buyer. I wasn't educated. I was excited to buy a home. Right, I got down payment assistance, which we know that you can get that based on the county that you're going to buy in, because down payment assistance have limitations based on where you're going to buy. So I was offered down payment assistance. I had decent credit. At that time, I bought my home in my own name. Well, the market crashed, right? I lost a lot of money. I think I paid at that time 07. And most people don't realize during that time, 5% was the average rate to buy a home. We didn't have these 2%, 3%, interest rate when buying a home in 2007.
Yep.
And so I got, not me, but a lot of people got caught in that housing market when the whole market just went bad. My credit was bad. I ended up filing bankruptcy to get out that house. Filed bankruptcy. And during that time, I basically repaired my own credit. So I didn't know anything about credit, repaired my own credit. I was able to build my credit back up just doing the different things by, applying for secure cards, and paying on time, not really leveraging my credit, but making sure I was paying on time and not overutilizing my credit. I then had the opportunity in 2016 to buy my first investment property in Oakland, California. Now we know that California is a very expensive place to purchase real estate, right? Making six figures in California is not really a lot of money. You need like sometimes two and three income, because at that point, when I bought the house, my husband and I in 2016, I paid $185,000 for that house in Oakland. It's a 1920 house. That house is almost worth 500K today, easily, right? So look how much equity that I have in that property. And what I would tell you guys, what credit have allowed me to do, or my husband and I to do, is I have tapped in that equity so many times. And when I see that, right, because
Study
equity
part.
is there, right? And so it's there for us to use
Mm-hmm.
it, but it's for us to use it responsibly, right? It's not for us to use it to go on vacations, or go buy designers. It's used to create other assets, right? And so for us, we use that equity to buy our primary home. I took out like $50,000, paid off some debt, bought my home, made sure my credit was right. And credit is a sacrifice, right? There are so many things I had to do to buy that home. That means that I didn't shop, right? I watch how I spent my money, because when you're trying to elevate and you're trying to acquire these assets and you're trying to get these loans from these banks, there are certain criteria that you have to meet, and you have to be willing to make those sacrifices. So, like I said, credit is everything. I've learned to leverage my credit. I've learned to repair my own credit. And that's how, with my expertise and my experience, I've been able to help other people also, repair their credit and teach the importance financial literacy.
Dope, dope. So piggybacking off of that, Tasha, as a realtor, and you see the market in a different aspect. So you hear Nina how she said she acquired a home when the interest rates were high, when the '08, when the market crashed and all that. So as a realtor, you get to see that in real life all the time, right? And
Mm-hmm.
you see not only the ups and downs of it personally as you selling those homes, but you also see the people that try to qualify for those homes and can't qualify, where you have to go back and tell them, hey, I'm sorry, I can't help you because of XYZ on your credit, or you don't have enough income and things like that, right? So being that
Yeah.
we know that the the real estate in itself can be an asset or a liability, how do you look at that from a realtor's perspective?
Well, so when it comes to the credit and getting approved, a lot of people have this preconceived notation that credit cards are bad. And I really think that at the end of the day, it's mindset, getting out there, getting the information so you can understand what you need to do to prepare, because you do have to prepare. It took me a while to prepare to purchase my home. I didn't just get have some money in the bank and be able to go prepare, I mean, go purchase. I had to really structure um, my credit so that I can get higher limits. And the higher your limits are, the lower your interest rates. So a lot of times people, they want to go buy a house, but they can't afford the payment. And then they are hit with the larger payment because of the interest rate being higher because of their credit being lower, right?
Mm-hmm.
And so that's an important factor. So I did this analogy for uh, for individuals is when you buy. It's interesting when people have bad credit, right? So say for instance, let's use Joan for Joan and John. So Joan got a credit score of, let's say, 720, right? Joan go purchase a home. Her interest rate might be 3.5%. Joe go purchase a home. His credit score is what, 620. The low,
Right.
580, 620. He go purchase a home. His interest rate gonna be double the amount that Jones is, if not more. And over a period of time, Joan may only pay, and these are very, very figurative numbers, but Joan may only pay what, $50,000 in interest, right? Whereas Joe will mess around and be paying $250,000 in interest over the course of 30 years, right?
Right.
And so, and that's the same thing even with a car, right? And so what people don't understand is credit actually saves you money. You know what I mean? And so when you have that mindset where you use it to benefit. So let's give the analogy of John and Joan, for instance. We were talking about with the interest rate. So Joan may end up only paying $20,000 in interest over a 30-year course, whereas John will pay 250,000 because of his interest rate being way higher than her. She might have a 2.75 and he might have a 6.5 just because of where the credit scores are. So people really need to understand the impact that credit has. You end up spending more over a period of time when it comes to interest. So for me, and that makes your credit, I mean, your mortgage payment, your monthly payments go higher. But all in all, whenever you go to acquire real estate, a lot of times people are looking for that dream house on the first go round. And I think for me, what I'm seeing is that what separates a lot of people that go and purchase and really excel is mindset. Mindset is everything, right? Your perspective is everything. And one thing about that I hear a lot of is, well, shoot, that's too high that I'm paying in a mortgage, but guess what? You're going to eventually be paying that on somebody's rent, because the market is always going. How often do we see rent come down? It's always going up, right?
Yep, for
The
sure.
thing is, you don't benefit nothing from renting. And then on the flip side, not unless you use it like what Nina is about to tell you, but and then on the flip side of renting, whenever that owner get ready to sell, they can put you out. I'm dealing with a client with like that right now, who's like distraught because she got to be out in 60 days, and it's hard for her to find a property, another home, because rent went up so much since she first got into her property. So she got into her property and started leasing that property like 5 years ago, and rents was much lower than they are now. So she didn't even think about, she ain't had to worry about that. But now she out there and she has to go look, and it's like, is this really what the rents are right now? Yeah. And you benefit nothing, and now it's hard for you to buy. So for me, I think the mindset of it is that you have to go in there and you got to crawl before you walk. You might not be able to go and get the biggest house you want. You might have to start off, and I highly encourage people to start off with a duplex. One of the things with a duplex, if they can, um, they can use the other side as income to help pay for the side that they live in. There's programs out there where you can get these homes for free. Like, talk to people. Don't just go off the first person. I say interview lenders to see what they can offer you. There's a program right now. It's a 10% um, equity program where what is it called? It's 10% forgivable equity grant right now that they have out here in California. So basically, you can get another house. If you have a home, you can take out the equity and purchase another home, and you can use 10% of that equity, and it is forgivable after 5 years, right? Talk to your lender for more details, but you can use it on an FHA loan, you can use it on a VA loan, you can use it on a CalHFA, and you can use it on a USDA. So there's programs out there that will allow you to use other people's money if you don't use your own credit and whatnot to purchase home. I know I'm a little long-winded, but
No, it's all good.
it's just so much when it comes to this, man.
All right, so we have both of those frames of what it looked like when it comes to acquiring real estate, and you touched on something that I think is important, which was um, what most people maybe call house hacking, and that's acquiring the first property, maybe a duplex if you can, depending on how big your family is, X, Y, Z, right? Of course, there's factors that go into that, but just on the principles of leveraging the good credit, acquiring an asset, living in one side, creating income from the other side, which now makes it an income producing asset, right? Um, when people approach it from that, and a lot of that has to do, like you said, mindset, information. People, we always lack of information because there's a million different programs out here. You named off about 5 of them right off the muscle: the FHA, USDA, Cal Halfa, all these programs that help people acquire them. But a lot of times, people don't even understand the value in what they pay for rent and how much house that buys them. So,
Mm-hmm.
and when you look at it from that aspect, and you can produce income in a rent space as well as a purchase space, Nina, you can touch on this because you using the aspect of the rent space to create income as an income stream too. Can you touch on that?
Jay, can I say one thing? I'm so sorry.
No, go ahead.
What I want to do is I want to say, keep in mind that when you're doing purchases, for, as a to be able to do the house hacking, you can do it for up to 4 properties, 4 complexes. So we always hear duplex, but you can do a triplex, you can do a fourplex,
Facts.
and still utilize that same concept. Once you get into 5 and up, then that becomes commercial. But I just wanted to make that disclaimer too.
Good point. Facts. Go ahead, Nina.
Yeah, so what Jay was saying about how you can take your rental properties and produce assets. So that's what I do. So my rental property that I have right now, I don't live in it. You know, I've been renting it out for the last few years. And I don't know how many of you guys are familiar. I have this place on Section 8, right? Section 8 is not a bad program to get into if you're a landlord, right? And right now, for instance, right now, based on I know certain county like City of Oakland, due to the housing market and the prices, they are really recruiting landlords now, and they are compensating landlords, new landlords, to put your property on Section 8, right? So you're getting paid from the housing authorities to become a new landlord to so that you can attract these Section 8 clients. And Section 8 is not a bad thing, right? People, it gets a bad name, but it's really not. It's a guaranteed income that
That's
you
that for
get.
show money.
It's for sure money, right? And I say this because I know that some people, a lot of landlords frown upon Section 8 because of the history. That a lot of tenants,
Hmm.
they tear up the property. They think that Section 8 is like bad people, black people. It's all races that get Section 8, right? You do your due diligence, you run, credit checks and make sure the person is reliable, check the references, whatever, right? So for example, during the pandemic, I didn't have any problems with my rental income. By having Section 8, I was secure to where it did not put me and my husband in a financial situation to where we could not pay the rent. The money was direct deposited into our account every first of the month. So that was guaranteed rent income. So don't sleep on Section 8. So again, I use this property right now. So this property not only pays the full mortgage, it also gives me about $1,000 profit every month that I can now take that profit and apply it to my current mortgage where I live at or other things, right? So that is an incoming producing property. You want a house that's going to pay for itself, right? And my property absolutely does that, right? So I have that one investment property, and I don't know if I talk about Airbnb as well. I also do Airbnb. So that passive income, but just don't sleep. How should withstand how sometimes we get these houses and sometimes we are afraid of or paying this mortgage, right? You can rent out rooms to produce different incomes. They have so many like Airbnb. They have nurses who travel nurses who can rent rooms out to help pay for some of that mortgage, right? I've seen people sometimes rent out rooms for $1,500 a month. That's one room. Say you got 3 bedrooms, right? And you rent out 2 of those rooms. That's 3K, and I'm pretty sure that 3K will pay for your mortgage, right? So there's different things you can do to create passive income. You can not live there, rent the whole house out. You can Airbnb it, right? Do corporate housing, corporate leasing. You can also live there, rent out rooms to different nurses, people that's traveling from work, whatever the profession is. There's different ways that you can subsidize that money and bring in income to do other things to help you with paying your mortgages, right? And um, for me, I think that was one of the greatest benefits. This rental property has not also afforded me the opportunity to create passive income, but it's also has allowed me to do other things with my money, like use the equity to pay off debt, right? Paying off debt lowers my utilization, can then help me now go out and acquire more rental property, right? Because now my credit is good, right? My income is good. And you can use that income that you're getting from that property to acquire more assets. So that is the really good thing about having an investment property, a rental property. There's different ways you can tweak it so that you can produce income for that one location. Live it, rent it out. You can do home agencies for that house. There's so many different things you can do with a rental property if you do not want to live there to help create other assets to pay for that mortgage.
So you touched on the Airbnb model, right? So
Right.
in the Airbnb model, from an aspect of not purchasing a property to Airbnb in it, but to rent and create an income stream from renting that unit. Speak on that a little bit. That arbitrage method.
Yes. So I have two Airbnbs, what we call them short-term rentals, kind of the same language.
Mm-hmm.
Rental arbitrage. So in rental arbitrage is when you go out and you acquire property on a lease. Some leases are 12 months, 24 months. You can do private landlords, you can do rental, you can do apartments, and so forth. Rental arbitrage is in my business name. And I say business because let's go back to credit, because credit is the key foundation to everything, right? So I've learned to leverage my personal credit to then be able to create business credit, which the business credit has allowed me to now create rental arbitrage under my business names. So you don't want anything tied to your personal name. So these Airbnbs that I have is strictly rental arbitrage. There is no really liability to me. At the 12 months, you can either renew the lease or you can get rid of it, versus you going out buying a home. You're stuck with that home for 30 years, 15 years, right? Rental arbitrage is also based on location. Location is key in finding the right location to produce the income that you need, right? Because um location is a key on how much you're going to make, right? So you want to be close to attractions, you want to be close to like downtown areas, bars and restaurants, right? The most important part is that you have to kind of agree to the complex, agree to your business model, right? So it's always, it's not, it's what you say. It's not what you say, it's how you say it. It's how you sell your business model to the apartment complexes, right? And you can own 4, 5, 6, 10. The people I know who have multiple rental arbitrage, and these are just passive incomes that they are making every month without owning any property. But then also you can use that income eventually and purchase your own property if you want, right? So I like rental arbitrage because it's a less liability on me as a person, right? I don't have to go out and purchase 10 properties. I can go out and get 10 leases, and when I'm done with them, or if that's not producing me the income that I want, I could either break that lease or I can renew it. Right now, my one of my rental arbitrage, I end up acquiring two short-term rentals in a 2 month period, right? And one of them is doing excellent. It's doing excellent. It pays the rent there, and it also produces me extra money a month. You can do short-term rentals where you do a minimum of 28 days. That's considered short-term rentals. Or you can do long-term rentals, which is less money, but it's guaranteed money, and you can have people live in your properties for months at a time, 3 months, 2 months, doing a lease with them to make sure that you are not violating tenant. They don't have any tenant rights. But I will also state that a lot of different states are really cracking down on short-term rentals. So make sure that if you are interested in doing Airbnb short-term rentals, that you look at the city ordinance and make sure that you are allowed to do short-term rentals in that state, because they are starting to crack down where they're limiting how many short-term rentals you can have, where it's requiring you to have a permit. So do your due diligence, your research. They have different software that you can use to make sure that you can search by states and cities to make sure that the occupancy rate is good in the location that you want to start Airbnb, because it's not just like, hey, I want to go do Airbnb. You got to do research. Do your research and make sure that before you sign this lease, that you're going to be able to rent this unit out and make some money. Because the last thing you want to do is get an Airbnb that's not producing any passive income, and then you're stuck paying not only where you reside at, rent, but you're also obligated to pay that monthly rent at that complex or that landlord. So don't be afraid to tap into rental arbitrage. It's another way of passive income, to where when I say it's a no-brainer, it's a no-brainer. My systems are automated. I don't do anything. Everything is automated, from the messages to the check-in process. It's a really great industry to get into, to where you're not really working in the business. You can be in Hawaii and your businesses is still making money. So the key is to make money while you sleep, and Airbnb rental arbitrage can do that for you. And when I say that, I've been listed for about a month. I think I didn't make over 4K just in 1 month period off just that one rental. So you see what I'm saying? And the rent is less than that. So that's what I mean. Like, I make money in my sleep. I get a booking, it's taken care of. They check in, I get paid next day. So it's really a simple process, but you got to do your due diligence and making sure that you have the right Airbnb to make sure that the income is great.
All right, so and from both of those aspects, right? Like even the formula and the automation into it, the information, um,
Mm-hmm.
right? And we talked on mindset, right? So Tasha, I'm gonna have you touch on the aspect of when you put all these scenarios together and someone wants to go execute, right? Let's break down some of the mental barriers and myths that go into it, because I know I see it all the time where people think that you have to have this, extraordinary amount of money. You have to have, live in certain neighborhoods. You have to come from certain backgrounds. You have to be trust fund babies to be able to take advantage of the things that you guys been talking about up to this point, right? And everything from
Gosh.
leasing Airbnb. Nephew over there on one.
He owns the day.
All right, so building off, both you guys' conversations up to this point, dropping these jewels. If y'all ain't following them, y'all ain't paying attention, right? Because it's a roadmap at the end of the day, and now we're gonna tie that roadmap in together. So let's break down the myths of, what it takes to actually get into these spaces and the roadblocks that most people think that mentally they feel like they can't get into it or they can't do those things because of XYZ, or they heard XYZ somewhere, or somebody told them a lie about
Mm-hmm.
what it takes to actually acquire assets and be able to leverage those assets to create income. So being that Nina just outlined Airbnb and how you can lease a property, don't have to come out of pocket, don't have to go through purchasing homes and everything else. And you spoke on the different programs it takes to acquire property. What are some of the mental blocks and myths that we can touch on to break out people's mindset to let them know that these things are attainable?
The beautiful thing about it is that, when you have your mindset in a position to want to learn and to grow, you're going to put yourself around people that can help you grow, and you're going to seek to understand, right? And so when you are learning these things, one of the things that I always heard growing up was, don't use your credit cards. Credit cards are bad. Don't use your credit cards. Even the Dave Ramsey approach says, don't use your credit cards. And I thought that was dope. Like, yeah, Dave Ramsey has the blueprint. And then I start understanding credit cards, and I start understanding how the leverage can take you to a whole nother level once you understand. So really, it's not a matter of what you do, it's how you do it. You know what I mean? And
Right.
so if you have, if you don't have the history, knowing that you can go out and get trade lines, either if you have to pay for them, or if you can get creative and ask one of your aunties with good credit that pay her bills on time all the time, and have long history, you can ask her to put you on for free. You don't need the card or anything like that, and that helps you build your score. Having those credit cards and having that leverage, you can pull that money out on your credit, go drop it on a property, but you need to make sure that your mindset is in the right part, in the right place, where you're going to use that to create assets, right? So that's the difference in making sure you creating assets over liability, right? So another thing that people don't realize, because the biggest thing, then the first thing that people hear is, you got to pay your down payment, and you got to pay closing costs. With FHA, down payment is usually is always 3.5% of whatever your purchase price is. With conventional, I've seen as low as 3%, right? Where everybody has this myth that you have to pay 20% when you come in conventional. I've seen 3%, I've seen 5%, I've seen 10%, and I have seen 20%. But you need to know and have people that have lenders that will be able to break that down and differentiate why or how you can get the 3 versus the 5 versus the 10 versus the 20. Now, when you have investment property, and then, let me go back. So as far as the down payment and the closing costs, another thing, they have down payment assistance programs, right? But with the down payment assistance programs, you are going to pay a little bit more on the interest rate. So you always want to ask, what grants are available to me? Grants, you don't have to pay them back. So that's the difference, right? And it's not going to increase your interest rate based on you being able to qualify for a grant versus a down payment assistant, right? Another thing that people don't do, and I don't know if this is just a pride thing, or maybe sometimes people don't have people that they can ask for, but you got to get creative, is you can ask for gifts. You can ask for a gift and say, hey, if you got that mattress money, give it to your cousin Billy and say, Billy, take this, and I need you to write it as a gift because I know you got the money in the bank. I just need to show that it's seasoned so that I can use this to pay towards my down payment or my closing costs, right? Another thing you can do is if you're on, say, looking to get investment properties, there are ways where you can go out and find sponsors. There are people who want to invest in real estate, but they don't want to do the work, right? So you get with some people that get you a realtor that's constantly looking for deals, or that's in that line where they are connected with investors or whatnot. You get them and you find sponsors that will pay the down payment, but they get a piece of the pie, right? And nobody doing work for free, but you do the work and you get to learn how to. Now this is more so on a business side. I would highly encourage somebody to have their LLC and things like that in place, but you can learn from them by allowing them to put the down payment, pay for all of that, so where you're not coming out of pocket. This is another way to not have to come out of pocket. And then because you put the deal together, you can get what's called an acquisition fee, right? So you get an extra percent on the back end just from putting all the from doing the work, basically. But you didn't have to fork out anything and you still come out on top. Like I said, they get the piece of the pie. And if you do that 3 times, now you become what to the bank, what's called an expert. Now you have some experience on investment properties, and now they'll start looking at your portfolio and say, hey, well, you have experience, you have the money, we'll go ahead and we'll loan you this, as long as the pro forma, which is the breakdown of how much that investment can make, as long as those numbers make sense, they'll give you the money without you having to come out of pocket, have those sponsors in place and things like that. So again, it's mindset, it's getting in the right rooms and getting the information. And don't be so quick. Everybody be like, hurry up and act fast. And yeah, you do got to act fast, but you got to act fast and act smart. Do it in a wisely way, and make sure you have people that really have your best interests at hand.
No doubt, no doubt. Now, if if you guys, either one of you, Tasha, you already got the mic. So if you had to drop and give somebody a jewel right now, what would that be if they was looking to acquire their first property?
If they're looking to acquire their first property, I would say, in every scenario is different. The first thing I would say is get your credit in order. Period. Get your personal credit in order,
And at
and
the
make
minimum,
sure.
what's in order, just so they have a target, right? Like at the minimum, what should their score be?
I love to see my clients be at a 720, but if you the minimum 680
Okay.
for me, because the like I said, the lower your scores is, the higher the interest rate, and in that, the higher your mortgage. Yeah.
Now, and
Another jewel,
go ahead.
like I know you said one. Can I give
Yeah.
two?
No. Yeah. Go ahead. Sure. More the
So
better.
another jewel that I want to drop is that when you do get a mortgage, right? A lot of times you'll go into a 30-year mortgage. Well, if you add an extra $50 a month to every payment you make, and make sure you specify, this is the key, you have to specify that this extra $50 is going towards the principal. Because if you just make an extra $50, they're gonna break it up and put some towards principal and some towards the interest. What you want to do is knock down that principal so that you don't have to pay as much in interest. I've seen an individual do that. They had a 30-year mortgage and they paid $50 every month like clockwork. In their mindset, that was how much their mortgage, but they always put it towards the principal. They paid their house off in 15 years.
Bingo. Now, one thing I want to touch on too, because when you say a 680 credit, right? In
Yeah.
real estate, in a mortgage, right? they look at all three bureaus. They don't look at a single bureau like they do with credit cards or auto loans or nothing else. And it's a thing called a middle score. So tap on that
Mm-hmm.
so they understand what that mean when you come into real estate with your middle score as a 680.
Right. So what they do is they take you have three scores. You have the largest score. Your largest score might be the 720. Your lowest score may be TransUnion, and that might be only a 680. And then you have your middle score where it's a let's say 690. They're gonna take that 690, right? And then also if you're coming in with somebody else, right? And they scores is even worse, they're gonna calculate those the middle of all of the scores. They're gonna sum them and take whatever that middle score is. And so you got to keep that in mind too. So if you're going in to purchase with somebody else, you want to make sure that their scores are intact as well, because that can also affect you.
Equal or better.
Yes, sir.
All right, Nina. So if you have to give them one or two Jews, you can decide three if you want to. And they wanted to start creating a some type of cash flow producing asset or business. What would you recommend if you want to give them not a recommendation, but a jewel that you would give them to start that process?
So, me just having experience with purchasing real estate, I think for me, or for anyone, I think your first property should be either a multifamily, a duplex, or a triplex, because single homes are okay, but when you think about just like passive income and things of that nature, multifamily, like I said, like a duplex, a triplex, right? So that you could then rent those homes out to acquire more income. Another gem I like to say is that when you buy your home, never get attached to a home, right? Don't, no feelings, because the average person probably move a few times in their life, right? I would say continue to build multifamilies and make sure your primary residence is your last residence that you purchase. Build your portfolio. The key is to build your real estate portfolio, get these multiple doors. And then once you have the multiple doors, allow those doors to then pay for your dream home, right? Single family home should be your last purchase that you make. I did it ass backwards because I didn't know, right? You don't know what you know.
Mm-hmm.
So I would say that. Another gem also, as Tasha was speaking about how you can pay down or pay $50 a month towards principal. Another gem that you can do is called velocity banking. Is another way that you can utilize a line of credit, right? And you guys can kind of Google a little bit about like how velocity banking works. But it's another way that you can borrow a lump sum of money and apply that to your principal of your loan. So say your credit is good, right? You can get a line of credit and you get a, like say 50K. Take that whole 50K and dump that into your mortgage, principal only. So now you didn't cut down so many years off your mortgage. And then in return, a little bit how it works in velocity banking is that you take your incomes, your check, your spouse check, and you're dumping all that monthly income back into the line of credit, right? Because line of credit is always revolving. So once you put that, say you 50K is the line of credit, right? Say your income is 10K. Every time you get paid, you're going to put that money into that loan and to keep decreasing that balance. You're managing your monthly expenses. You're going to keep doing that over time until you are able to pay back that 50K. So that's another fast way to knock money off your principal of your mortgage by using velocity banking as well. I've used velocity banking to pay off 3 cars. And I paid off 3 cars in a matter of what, a month, which would have probably took me 2 years or three based off interest and paying off those core if I would have continued making a monthly payment. So you guys go ahead and check out Velocity Banking. You can use it to make payments on credit card debt. You can use it to pay off your house sooner. There's different ways that you can use Velocity Banking as well.
Dope, dope, dope.
Are
So
you familiar with infinite banking? Kind of make me have that
Yes,
same
that's with the
mindset.
kind of the same way with insurance. I have not done infinite banking. I've heard about it, but velocity banking is a great way to decrease a lot of your large balances on your home, your cars, or whatever. As I just said, a 700 credit score is actually great, the better the score, the cheaper the rates are. So you got to keep that in mind when you get these houses. 700 is a perfect above. It's a better score, because the better your credit score is, the cheaper the rate you're going to pay, right? So that's
and
kind
more
of
money.
Yep.
the more money that you're saving, right, on that mortgage.
Yep. Same concept. One just is through life insurance, and the other one is through regular loan.
Yeah.
So same concept.
Right.
Um, so Nina, where can they find you if they want to tap in and get their credit fix? Get some type of mentorship or whatever. Where can they find you and tap in with you at?
Absolutely, you guys. So my company, you can find me online at Instagram and Facebook as Rising Elevations. Both pages, you're able to book a consult for free, for 15 minutes to check in with us. We could do a credit audit to see, what are your goals and what you're trying to accomplish. We definitely can assist you with that. Also, I will be starting doing my Airbnb courses probably in a few months. So I'll be teaching you guys on how to go out there and obtain these short-term rentals, which will be including, scripting, how to set up your LLC, how to do your research on making sure that the Airbnb can be profitable, and just teaching you different ways how you can automate the business, how you can hire cleaners. And so my goal is to really teach you about passive income, because the goal is not to really have 7 businesses, right? The goal is, how can you create multiple streams of income with that one business? You don't need to go out and create 7 different LLCs, right? You can for funding purposes, but you can also have one business and have other entities underneath that one business that can produce you all these multiple streams of income. So focus on that, right? Don't focus on trying to create all these businesses as a beginner. Focus on, how can I leverage and create multiple passive incomes under this one business. So you guys can find me Instagram, TikTok. On a TikTok, I'm under Miss Nina underscore, I think B, or B underscore. You can find me on TikTok as well, where I also give you guys tips and resources on how to, do Airbnb and how to repair your credit and so forth. So yeah, check me out.
Check her out.
Tosh, where can they find you when they want to buy a house up in the Bay, in the North, in the Sac?
Man, so check it. You guys can find me on Instagram as Miss Realtor Tash. That's MSREALTORTASH. You can also find me on Facebook under Natasha Bass. I'm on LinkedIn under Natasha Bass. I'm on TikTok as Miss Lady. I mean, just type in my name wherever I am. Give me a call. My number is 209-598-5500. If you're looking for credit, you can definitely reach out and find me on at our website, Intel Financial Solution, and that's www.intelfinancialsolution.com. And man, I'd love to service you and anyone looking to grow in financial literacy. Our real estate is so much. And if I don't know it, guess what? I know somebody else who do. For sure. Keep it moving and keep it popping.